Welcome to What They Really Said. Today we're really ignoring the ticker tape. We're looking past the hourly price headlines, the social media chatter. We're going to tear apart a set of sources that you, the learner, shared with us, and they really demand that we look beyond that daily volatility and, straight into the foundational reality of the Bitcoin ecosystem.
That's absolutely right. This is a deep dive that centers around the recent strategic thinking laid out by Michael Saylor.
Right.
And his analysis is, well, it's sweeping. It moves far past just price prediction. It goes deep into the regulatory, the economic, and the technological transformation that's happened over the last year. And it all culminates in this vision to create the next generation of global credit and money.
And what makes this so compelling, I think, and even a bit paradoxical, is the timing.
Yeah.
If you look at the source data, Saylor gave this interview when Bitcoin was trading around, what, $87,000?
That's right, 87K.
And just a year ago, we saw it cross 100,000 for the first time. So if you just glanced at the near-term chart, you might think, okay, the momentum stalled, or maybe institutional interest has faded away.
And that perceived underperformance
Mhm.
is the critical starting point. It's the whole reason we're doing this. If the price is down, why should any sophisticated investor or curious learner dedicate time to understanding the fundamentals?
Exactly. Why care?
Well, Saylor's core thesis, and this is really the mission of our deep dive today, is to prove that despite that price, the last 12 months have been, and this is his estimation, probably the best 12 months in the history of the industry.
The best 12 months.
The best in terms of those foundational, structural, and regulatory shifts.
That is an incredibly bold claim, especially when he's outlining an opportunity he thinks is worth $200 trillion globally.
It's a huge number.
So we need to dissect what created this massive gap between, the surface level price story and this profound infrastructure reality that's being built underneath.
Let's unpack this foundational idea. Okay, so let's start right where the skepticism lives, the price. If the market is so robust, if institutions are supposedly piling in, why are we sitting at 87K down from 100? Where is all that short-term volatility coming from?
Saylor paints a very clear picture of the market structure. He separates the market into two really distinct groups. He estimates that something like 85% of all Bitcoin is held in what he calls crypto OG hands.
OG hands, so long-term holders.
Exactly. People who are, for the most part, anonymous, and they are essentially unmovable. They're not selling based on daily news or, a 10% drop.
Right. They're the long-term capital base. So that means the remaining 15% is driving all the immediate price movement. Well, not just the remaining 50% of the coins, but, and this is crucial, the derivatives market that's built on top of the entire asset class. The source estimates the total capital in the perpetuals and derivatives market is. It's around $1.7 trillion. Now, just imagine the capital leveraged 20 times or even 30 times.
Wow. Okay, so we are talking about highly leveraged, highly speculative capital. If you have $1, you're essentially trading with $20 or $30 of exposure.
Precisely. And this enormous pool of leveraged capital, which is held largely by unknown entities, is what drives the daily mood swings. It drives the rapid liquidations, the short-term market corrections. It's highly technical, it's highly emotional, and it's completely divorced from the long-term utility or the institutional adoption of the actual underlying asset. Saylor basically just dismisses the near-term price as noise, pure noise compared to the fundamental shifts that have been piling up since the end of last year.
Okay, so if that's the short-term noise we can sort of safely disregard, what exactly has shifted on the foundation? Let's get into that best year ever checklist you provided. Where do we even begin with this avalanche of positive regulatory news?
The primary shift, I would say, is the political and regulatory landscape in the United States. For years, Bitcoin operated under this cloud of existential regulatory uncertainty.
A huge cloud.
A huge one. And Saylor argues that this year marked the end of that era. He specifically points to the presence of a universally supportive U.S. administration. And that includes not just the president and vice president, but also supportive heads at the SEC, the CFTC, and the Treasury. I mean, that political alignment alone removes the single biggest structural uncertainty the asset class has ever faced.
Removing that political headwind is enormous, of course, but the real substance has to be in the tangible regulatory clarity. What specific guidance was actually delivered that matters most to an institution?
We can really identify three key regulatory milestones here. First, the formal and public recognition of Bitcoin as a commodity. Saylor highlighted how significant it was when figures like David Sachs publicly stated back in March that Bitcoin is firmly a digital commodity. He said it's analogous to digital gold and, critically, an asset without an issuer.
Okay, let's break that down. Why is the commodity status such a huge win, both philosophically and practically?
Well, it's because it bypasses the entire contentious debate about whether Bitcoin should be classified as a security.
Right, which would put it under much stricter SEC regulation.
Much stricter, much more invasive. By solidifying its status as a commodity, it's recognized as propagating fundamental property rights and freedom. That de-risks it for the largest, most conservative institutional investors who want to avoid all the legal complexity that comes with security offerings.
That distinction makes compliance so much simpler. Okay, what about the second big hurdle? That's always been tax treatment for corporations. What relief did the IRS and Treasury provide?
This one is a massive de-risking factor for corporate treasuries. There was favorable guidance that came out of the IRS and Treasury that, according to the source, eliminated the whole issue of unrealized capital gains tax on crypto assets.
Okay, let's unpack that specific issue for you, the learner. Why was unrealized capital gains tax such a nightmare for companies holding Bitcoin?
Right. So imagine you're a company like Strategy, and you're holding Bitcoin on your balance sheet. If the asset appreciates under the previous rules, there was ambiguity or often a requirement to treat that paper gain as a taxable event.
Even though you hadn't sold anything.
Exactly. Even though you hadn't sold the asset. This created these immense complex accounting and compliance burdens. A company could literally be forced to liquidate other assets or even take on debt just to pay a tax bill on an asset they were holding for the long term. By removing that ambiguity and making the tax liability clear, you only pay when you sell, the government effectively lowered the compliance cost of holding Bitcoin to zero, and that makes it immediately more attractive as a Treasury reserve asset.
That's a powerful incentive for corporate adoption. It just removes a massive barrier to entry.
Which brings us to the third point, corporate adoption itself. Saylor put a pretty definitive number on this institutional shift.
He did. He estimated that approximately 200 publicly traded companies added crypto assets to their balance sheets in the past year. And, this isn't just a list of small tech startups. These are companies following the path that Strategy pioneered. They're moving Bitcoin from a niche investment to a standard, legitimate corporate reserve asset.
And we should point out, his own company's activity is probably the clearest evidence of this accelerating demand. I mean, they didn't slow down when the price dipped.
Far from it. Strategy raised an astonishing, $23 to $24 billion this year alone. They purchased more Bitcoin than in any prior year. And this signals two things. First, that institutional demand for exposure to digital capital is accelerating. And second, that Wall Street is now fully comfortable packaging and selling these sophisticated digital asset investment vehicles, regardless of what the short-term price is doing. So we have this profound dichotomy. On one hand, the price is being jerked around by a small percentage of highly leveraged emotional capital. But on the other hand, the vast majority of institutional money is flowing in against a backdrop of complete regulatory clarity, favorable tax guidance, and corporate validation. The foundation is set.
And if you connect all this to the bigger picture, it means that the infrastructure uncertainty that plagued the space for a decade, that's gone. The market is now just catching up to the regulatory reality. And that reality is what enables the next phase, deep institutional integration.
And that integration, it requires efficient trading tools. Saylor talked about two major breakthroughs in regulated trading, the ETFs and the derivatives market. He used a great phrase for the spot Bitcoin ETFs. He said they were uncrippled.
Yes, uncrippled. And what that refers to is moving past the initial constraints on how these ETFs could operate. Specifically, it involves the functionality of in-kind creations and redemptions.
Okay, let's unpack in-kind creation and redemption in detail, because this is, it's highly technical, but it's fundamentally important for how institutions can move money around.
Right. So previously, in the more constrained model, market makers often had to deal only in cash. If they wanted to create new shares of an ETF, like IBIT, they had to deliver cash. If they redeemed shares, they received cash. This creates slippage, it creates tracking errors, tax complexity. It's inefficient. In-kind changes everything. It means an institution can now swap the underlying BTC directly for ETF shares and vice versa.
So for a major institution, they can just deliver, say, 100 Bitcoin to the fund and get 100 shares of IBIT back in return.
Precisely. And this allows for instant, perfectly efficient arbitrage. If the ETF share price tracks even slightly incorrectly relative to the underlying BTC, institutions can execute risk-free trades by swapping in kind. that immediately reduces tracking errors and ensures the ETF behaves exactly like the underlying asset.
Yeah.
And crucially, this efficiency allows the asset to be utilized in traditional financial services, specifically credit extension, which we'll get to in a moment.
This functionality really shifts Bitcoin from being a sort of novel, separate asset to a liquid financial instrument that it functions perfectly inside the traditional Wall Street machine.
What about the regulated derivatives market?
The expansion there was equally dramatic. Saylor noted that the onshore regulated derivatives market, it initially grew from almost nothing to about $10 billion. But then, when, quote, they actually took the cuffs off, it went to $50 billion.
Wow.
This expansion is vital because it allows institutions, banks, insurance companies, corporate treasuries to hedge their risks and gain exposure in a regulated, verifiable setting like the CME. This also included new guidance allowing Bitcoin to be used as collateral against derivatives contracts on these regulated exchanges, which further cements its utility.
So the combination of efficient ETFs and a deep regulated derivatives market,
Mhm.
that was the necessary precondition for the banking industry to finally, thaw out. It was the trigger. Saylor systematically documented this easing of regulatory pressure. He noted approximately 6 positive salvos of guidance from the OCC and the FDIC throughout the year. And these are the bodies that regulate and insure banks in the U.S. That consistent, positive stream of guidance provided the necessary cover and, the confidence for conservative banks to finally move.
And move they did. The source provides a serious roster of conventional banks making pro-digital assets announcements. Let's name them and explain the significance of what they're doing.
The list is staggering, really. And it represents a complete institutional about-face. You've got Citi, Charles Schwab, JP Morgan, Bank of America, BNY Mellon, Standard Chartered, and PNC.
That's a huge list.
It is. I mean, take Charles Schwab. Their move into custody and credit extension related to digital assets is massive because they manage trillions in retail wealth. Or BNY Mellon and PNC, they are huge custody and corporate service providers. Their use of services like Coinbase's crypto as a service, it demonstrates that all this back-end integration is happening rapidly and quietly. The dam hasn't just broken. The major rivers are now flowing toward digital assets.
And this is where it gets really interesting for me. Credit formation. A year ago, you could hold Bitcoin, but getting a loan against it was, well, it was nearly impossible. Now it's becoming integrated into the lending infrastructure.
Absolutely. Saylor described this transition perfectly. A year ago, you could not secure a loan against IBIT shares, period. Today, he identified 8 different banks actively offering credit against IBIT, and the terms are favorable. They're typically priced in the range of SOFR plus 50 to 75 basis points.
Okay, let's briefly explain what SOFR plus 50-75 basis points actually means for you, the learner.
Right. So SOFR is the Secured Overnight Financing Rate. It's the benchmark rate used by banks for dollar-denominated loans. It essentially replaced LIBOR. When a loan is priced at SOFR plus 50 basis points, it means the borrower pays the prevailing short-term interbank rate plus half of 1%.
Which is very cheap.
It's a very tight, low-cost margin for credit. It's typically reserved for high-quality collateral and highly rated counterparties. So this pricing signifies that banks view the IBIT shares, and by extension the underlying Bitcoin, as extremely high-quality collateral, not as speculative risk.
So the banks aren't just holding the asset anymore. They're actively building credit networks on top of it.
Exactly. And the future is even more integrated. Saylor noted that 4 or more banks are already planning to issue credit directly against the underlying BPC itself in the coming year. This marks the transition from the HODL-only philosophy to the utility layer philosophy, where Bitcoin is used as productive collateral to generate yield and credit in the traditional system.
And beyond banking, these quiet, almost bureaucratic changes in accounting and insurance, they're often the most telling indicators of normalization. What changes did we see there?
The accounting change is fundamentally crucial. Fair value accounting. Prior to this shift, digital assets were generally treated under these complex and, frankly, unfavorable rules. Most corporate treasuries couldn't recognize gains on their digital assets until they were sold. This forced them to potentially carry the assets at their lowest cost basis, which made holding Bitcoin look artificially punitive on quarterly reports.
Which means they couldn't reflect the true appreciation of their assets until 2025 or whenever the new rules were supposed to kick in globally.
Right, so the shift to fair value accounting allows corporations to accurately reflect the current market value of their Bitcoin holdings on their balance sheets. This eliminates a massive disincentive for Treasury departments and makes the asset class legitimate in the eyes of CFOs and auditors.
And the anecdote about insurance really illustrates the magnitude of this change in corporate trust and perception.
It's a powerful story. Saylor shared that when Strategy first bought Bitcoin, their essential D&O, that's directors and officers insurance, was immediately dropped.
Why?
For 3 or 4 years, they operated without the standard professional liability protection that's required for a major publicly traded company. That situation has finally been unwound, which demonstrates that the insurance industry, the ultimate arbiter of corporate risk, now accepts Bitcoin holding as a legitimate insurable activity. And on top of that, Strategy received its first ever S&P credit rating this year, which is another stamp of traditional financial normalization.
The final piece of this puzzle is the DTC, the Depository Trust Company. I mean, this is the nervous system of the global financial world. If they move, everything changes.
The significance here, it cannot be overstated. The SEC recently provided guidance that allows the DTC to potentially tokenize its entire security portfolio. Now think about what the DTC handles. Virtually all U.S. and global securities. Everything. This move implies that all global securities currently moving on the DTC rail could eventually be represented as digital assets, leveraging blockchain technology. Saylor noted the CEO of the DTC publicly expressed enthusiasm about this direction. This shows that traditional gatekeepers are not just reluctantly complying, they're actively planning to integrate and use this technology at the core of their operations.
So, to summarize this section, we've moved from a regulatory cold shoulder to clear support, from crippled trading mechanisms to uncrippled, efficient ETFs, from zero bank engagement to 8 banks offering credit, and from accounting complexity to full normalization. The institutional groundwork is complete, and that sets the stage for creating new financial instruments.
Exactly. The infrastructure is now ready to support the construction of the next layer, digital credit.
So the stage is set for a disruption that Saylor sees as a $200 trillion opportunity. That number is almost overwhelming. What exactly is this massive asset class he claims has been historically unbanked or, poorly served?
He's defining this opportunity as the vast global market of conservative capital. So think money market credit, corporate investment credit, bank credit. He estimates this pool is around $200 trillion today and could easily double to $400 trillion within a decade. And historically, this market is characterized by safety and liquidity, but it has one massive flaw. It often offers, and I love this quote, return-free risk.
Return-free risk, meaning you're taking on duration risk or credit risk, but you get almost no yield in return. Okay, let's look at the foundational economics of this, specifically the supply-credit equilibrium, which is just central to his entire thesis.
The economics are simple but profound. Saylor calculates the daily miner supply of Bitcoin. At the price in the source, 87K, that's 450 BTC mined per day, which translates to roughly $40 million a day, or approximately $15 to $16 billion of natural annual supply coming from the miners.
Okay, 16 billion is the supply entering the market every year. This is where credit creation becomes so critical. What's the key insight when we compare the $16 billion supply to the banks we were just talking about?
The core insight is leverage absorption. Saylor argues that every single time a bank creates $16 billion of credit backed by Bitcoin, that is one full year's worth of new supply taken out of circulation. It's effectively locked up as collateral.
One bank, 1 year's supply.
And he estimates that major institutions, Citi, Bank of America, JP Morgan, Charles Schwab, they are now individually capable of generating that entire $16 billion volume of Bitcoin-backed credit within a 12-month period.
So if just 1 or 2 of these global banks fully leans into their new capabilities, they could, just by creating new loans backed by Bitcoin collateral, absorb the entire annual new supply of the asset.
And that shifts the supply-demand narrative entirely. Demand is no longer measured just by outright purchases. It's multiplied by the velocity and volume of credit creation backed by the asset. It creates exponential demand pressure against a fixed and shrinking supply. And this is the whole rationale for Strategy's role, creating that digital credit middle layer, known by their instruments like STRC.
So Strategy is pioneering the issuance of these instruments. They grew the public digital credit market from nothing to $8 billion in 10 months through 5 IPOs. But why is this product even needed if we already have traditional bonds and money markets?
Because traditional credit is failing the conservative investor. I mean, if you look at sovereign debt, the yields are pitiful. Japan at 50 basis points, Europe at 100 BPS, the US at 370 BPs and falling. To chase any better yield, investors are forced into two really bad options. Either duration risk, meaning locking capital up for 20 years, or credit risk, meaning investing in uncollateralized junk bonds.
So they're accepting massive illiquidity or high counterparty risk just to scrape a few extra points of return.
The promise of digital credit is to reverse that trade-off. Saylor aims to offer a product that functions with the liquidity of a bank account but pays an 8% or even 10% yield. And with no duration and significantly minimized credit risk, STRC aims for a 10% tax-deferred dividend yield, but it requires the investor to accept 5 to 10 points of volatility, or what he calls 5 to 10 V.
Okay, let's stop right there. The audience needs to understand what V means in this context and how they actually achieve that low volatility.
Right, so V stands for volatility. It's the standard deviation of the asset's price returns over a given period. Bitcoin itself historically runs at about 50 V.
It's very unpredictable.
Very unpredictable price movement. And Saylor's entire financial engineering trick is to strip 80% to 90% of that volatility out by over-collateralization.
How does the over-collateralization mechanically reduce the volatility?
Well, they issue $1 of digital credit for every $10 of Bitcoin capital they hold. It's a 10-to-1 over-collateralization ratio. Because the collateral base is 10 times the size of the debt they issue, the underlying asset would have to crash by 90% before the creditors face any loss.
Which is a huge buffer.
A massive safety cushion. And that takes the asset from 50 V down to approximately 10 V. The investor gets a high yield for accepting a low managed level of volatility.
And that brings us to the ultimate ambitious goal, the 4-stage vision for rebuilding the world's monetary order. This ends in the creation of digital money, what he calls the stablecoin killer. Let's map this out clearly.
Okay, 4 stages. Number 1, digital asset commodity. This is Bitcoin, high V, high ARR, self-custody. It's the foundational collateral. 2, digital capital. This is Bitcoin solidifying its status as the world's ultimate store of value, the stable, appreciating capital base. 3, digital credit. This is STRC, what Strategy is doing right now, stripping 90% of the volatility via 10-to-1 over-collateralization to get a 10% yield with 10 V. And then 4, digital money, the 0 V product, the final stage. The goal is to strip that final 510 V to create a 0 V instrument that pays a 7-8% yield.
Wait a second. Saylor is pitching a zero volatility product that pays 8%. That sounds almost too good to be true. What's the hidden mechanism or the counterparty risk he's not talking about? How do you strip out that final 10 V?
The mechanism is sophisticated risk management, not magic. And the counterparty risk is minimized by the high-quality, liquid underlying collateral. To achieve that stable $1 NAV, or net asset value, he proposes blending 2 types of assets and then applying a cash buffer on top.
What's the blend?
It's primarily a portfolio of 80% digital credit, so instruments like STRC, which already yield around 10%, and 20% currency equivalents. Things like 1-month T-bills and cash equivalents, which provide maximum liquidity and minimal volatility. This blended portfolio might yield 9%, but it still carries some residual volatility. So to maintain the stable $1 NAV, they layer on a 10% volatility reserve buffer. That's the shock absorber.
So a dedicated cash reserve. If the value of the credit instruments dips slightly, they draw on this reserve to keep the NAV pegged at exactly $1.
Precisely. If the credit portfolio performs well, they continually fund that reserve, maybe skimming 100 basis points off the 9% yield to keep the reserve perpetually full. The net result for the investor is an instrument that never moves from $1 but pays a net yield of 7% to 8% daily. And that is 400 basis points, 4% better than any competing fiat-backed money market or stablecoin. That massive competitive advantage is the heart of the disruption.
And he emphasizes that this isn't, black magic. Any competent fund manager running a money market fund could execute this kind of structure.
He argues it's just financial engineering, but starting from a clean sheet of paper. The structure blending high-yield credit, cash, or volatility reserve is designed to deliver hope and yield back to the conservative investor. And the final step in this whole vision is the banking opportunity getting regulatory approval for a digital money account built on this 0 V architecture.
If that final regulatory hurdle is cleared, he makes the astonishing claim that the first bank to offer 8% daily yield on this digital money account could attract trillions of capital.
The implication is clear. Capital is rational. If you're a billionaire in Switzerland or a sovereign wealth fund in the Middle East, and you can get a guaranteed 8% return daily in a liquid, stable instrument versus 3.5% somewhere else,
You're going to move your money.
You are going to wire your money there. Saylor believes that bank or city-state would become the Switzerland of the 21st century.
And this capital flows back into the ecosystem, perpetually buying digital money, which then buys digital credit, which requires massive purchases of the underlying digital capital Bitcoin. It creates a perpetual demand loop.
It transforms Bitcoin from a speculative asset into the essential reserve collateral, powering the next generation of global monetary infrastructure.
Mm.
But Strategy's mission, however, is purely focused on that digital credit layer. They don't want to run the money fund or become the bank.
Right. They're the component supplier. They provide the highly efficient, low volatility, high yield engine that institutions can then plug into to build the final zero-V product.
Exactly. They are monomaniacally focused on converting capital into credit, stripping
Mhm.
80–90% of the volatility off the Bitcoin capital. This allows them to avoid the regulatory complexity of being a bank while supplying the most essential, high-performing financial component to the global financial system.
This philosophy of monomaniacal focus, as you said, is so critical to Saylor's strategy, especially in maintaining credibility with credit investors. Why is this singular approach so important for a company that's dealing in digital capital?
It all comes back to their economic baseline, what he calls the hurdle rate. Saylor explicitly anchors the company's valuation and its strategy to the expectation that Bitcoin will appreciate 30% a year for the next 20 years.
30% is the risk-free rate. I mean, just think about that. Every single business decision the company makes has to clear that incredibly high bar. That instantly kills 99% of possible business ideas right there.
It does. He calls their current strategy the acquisition of, quote, the world's reserve capital network at 1x revenue growing 30% a year for the next 20 years, risk-free, integration-free, overnight, no questions asked. I mean, if your baseline zero-effort investment yields 30% annual appreciation, any secondary project or acquisition has to not only exceed 30%, but also justify the immense operational integration and reputation risk.
Which leads directly to his robust argument against diversification or acquisitions, even of, say, distressed Bitcoin treasury companies trading at a discount. Let's break down the logic of why acquiring other businesses is just fundamentally detrimental to this mission.
The first and simplest reason is dilutive distraction. Saylor argues that any secondary idea undermines the primary mission of creating the digital credit layer for that $30 trillion credit market. If he spends 5 years convincing investors that Bitcoin is digital capital, he can't show up in the 6th year having acquired 16 different undervalued companies. It distracts the CEO, it distracts the executive team from the core mission.
And the second, and maybe more severe issue, is the impact on the credit investors. Credit risk and opacity.
Right. Credit investors who buy STRC only want one simple assurance: that the company's high-quality digital capital backs their credit instrument. They want simplicity and clarity. If Strategy starts acquiring other companies, mining operations, software firms, custodians, it immediately introduces opacity. The collateral mix gets complicated, and suddenly they don't just have liquid digital capital. They have, and this is another quote, Bitcoin wrapped in a giant cluster of unknown liabilities. That instantly creates a diversification discount, which penalizes the company's valuation and increases the perceived credit risk.
And the practical integration headaches. They're so often catastrophic in the corporate world. They just lead to value destruction.
He provides several concrete examples of this integration risk. Acquisitions are not instant. They take about a year to close. But the biggest danger lies in unknown embedded liabilities. You are purchasing years of accrued risk. And Saylor cited the catastrophic HP autonomy failure as a prime example of this.
Can you just remind us what happened there? Because it really illustrates the danger of these hidden liabilities.
Sure. In that case, HP acquired autonomy for $10 billion. Years later, they discovered massive accounting irregularities and fraud related to the acquired company's historical performance. The acquisition ultimately resulted in a stunning $9 or $10 billion write-off. It destroyed the entire value of the deal long after the ink had dried. Saylor argues that such acquisitions generate open-ended legal exposure, shareholder litigation, and most dangerously, potential unlimited bottomless liability from issues you had no hand in creating.
It's the anti-Bitcoin nature of acquisitions that he really drives home. Bitcoin is zero liability. A company is pure liability.
Exactly. I mean, Bitcoin has no employees, no management teams, no supply chains, no leases, no counterparty risk. None of the dozens of pages of liabilities a traditional company comes with. So why would he willingly absorb unlimited, bottomless liability and immense distraction when he can buy a zero liability, 30% per year appreciating asset overnight with zero integration headache? He says it is financially irresponsible.
And he connects this argument back to historical wisdom and the psychology of failure. He notes that having one great idea shouldn't lead you to immediately look for the next 10.
He quotes Marcus Aurelius, Just because you can do a thing doesn't mean you should do a thing. And he views the history of corporate failure through the lens of, quote, alpha males that solved one thing and think that that's solved and done, and they come up with 10 more things to solve. He calls it the Napoleon complex.
Yeah.
The historical lesson is that when you have identified a profoundly powerful idea, you have to nurture it with singular focus.
And he refers to Steve Jobs emphasizing the power of just saying no.
Right. Jobs' famous quote was to say no to a lot more things than yes.
Yeah.
Saylor sees himself as constantly bombarded by pitches for new, dilutive ideas, and he argues that the volume of bad ideas grows exponentially with the amount of capital available. The discipline is in the refusal.
So the entire profound, simple idea is to just put Bitcoin in cold storage, acquire it efficiently, and then leverage that safe, simple capital base to sell $1 of credit every year. That's the genius of focus.
It is the ultimate expression of maximizing the yield against the lowest possible risk and distraction. If you have a 30% hurdle rate opportunity in front of you, distracting yourself with something that yields 12% after the loss of effort and takes a year to close is just. It's fundamentally irresponsible to the shareholders who bought into the Bitcoin standard.
Now we move to how this complex digital credit stack, these instruments that are engineered to strip volatility and pay high yields, how they were even created. Saylor pointed to AI as the essential financial engineer that made these groundbreaking instruments possible.
What's so fascinating here is this collision of digital capital, which is Bitcoin, and digital intelligence, which is AI. Saylor argues that creating instruments like placing an at-the-market shelf registration on a preferred equity or designing a variable rate perpetual preferred equity that adjusts its dividend monthly but trades stable around par. These were conceptually impossible using traditional human systems.
Why did AI succeed where traditional bankers and lawyers failed to innovate? What's the core difference?
It overcomes human bias and heuristics. Traditional lawyers and bankers, they often tell you things are impossible because they rely on conventional wisdom, on precedent. They lack the capacity for comprehensive research. The human mind uses cognitive shortcuts and, has organizational baggage. The AI, however, can read, and he says, quote, 100,000 books of law and finance without prejudice, without an economic motive, and without the political fear of calling an outdated process stupid.
So it truly provides the engineer with a clean sheet of paper.
Exactly. Saylor compares it to the moment engineers realized the iPhone needed to eliminate the physical keyboard. They weren't optimizing the old process, they were eliminating an inefficient element that shouldn't even exist. AI allows financial engineers to synthesize all global legal and financial knowledge and design products that were previously impossible, unconstrained by the limitations of human experience or organizational inertia. And this was necessary to move from digital capital to digital credit.
Okay, let's turn to future challenges, starting with the biggest existential fear in the digital asset world, the quantum threat. Saylor maintains a strikingly optimistic, very engineering-focused view on this.
He contrasts the mindset. You have the pessimist who imagines the problem and is just doomed, versus the optimist who immediately imagines solving the problem. The quantum threat, the theoretical ability of future computers to break current encryption standards. He views it not as an existential collapse, but as a massive, global, forced system upgrade. He calls it a Y2K moment.
But how exactly does a decentralized network like Bitcoin manage a quantum-resistant upgrade that requires global consensus? That seems incredibly difficult.
It will be driven by necessity and institutional alignment. When global consensus forms, and it will be led by defense contractors, governments, and major institutions like Apple, Microsoft, and JP Morgan, the Bitcoin network will be forced to follow. They will ship new client software that uses quantum-resistant encryption. Holders of Bitcoin will then be required to install this software and re-encrypt their coins within a defined time frame.
This sounds like a really complex process involving every single holder. What happens to the coins that aren't re-encrypted by the deadline?
And that's what he calls the massive deflationary event. Any wallet belonging to someone who is deceased, who has lost their keys, or who simply fails to upgrade, they will never be able to re-encrypt their holdings. So those coins will be frozen forever, permanently reducing the circulating supply. Saylor estimates that if 5 million coins are permanently lost, the supply goes from 21 million down to 16 million.
That raises a really provocative question. Is the quantum leap, which sounds terrifying on its face, actually going to be the best thing to ever happen to the Bitcoin network?
He argues yes, because it achieves two things simultaneously. It strengthens the network security globally, and by permanently reducing the supply, it increases the scarcity and the value of the remaining coins. He stresses that the community, particularly those with $1 billion of Bitcoin, is highly motivated and intelligent enough to find consensus on these crucial security upgrades.
Finally, let's address the ongoing internal protocol debates, specifically the controversy over non-monetary data, like JPEGs or what some call spam, on the blockchain, and the proposals to fork Bitcoin to remove these features.
Saylor's stance here is one of hyperconservatism, and it reflects the need for stability in a system that's aiming to become a $200 trillion reserve capital network. He emphasizes that any fundamental change to the protocol must command near-universal consensus, similar to the quantum threat scenario. When half the community strongly opposes a change, his answer is, quote, slow down.
So inflexibility is the necessary feature, not the bug.
Absolutely. The lack of rapid mutation in Bitcoin's core protocol is what positions it as sound money. Mutation to him is the bug. He views attempts to fix these perceived minor issues as fundamentally dangerous because they introduce instability and they dilute its profound simplicity as a pure monetary protocol. Bitcoin succeeds by being the one thing that doesn't change, allowing it to serve as the stable base for all other innovation like the digital credit layer to be built on top.
This has truly been a deep dive into an entire financial and engineering philosophy. We covered three massive transformative areas this year. First, the dramatic regulatory normalization that has de-risked and validated Bitcoin, creating these clear paths for institutional integration. Second, strategy's audacious and highly engineered plan to build the digital credit stack, converting appreciating capital into a high-yield, zero-volatility digital money system that pays 8%. And third, the profound philosophy of singular, non-distracted focus required to achieve that kind of transformational success against a 30% hurdle rate.
And Saylor views his role as a missionary almost, spreading the gospel of digital assets. He highlights the humanitarian and egalitarian implications of this change. He contrasts the old system, where billions in developing economies face hopelessness and difficulty establishing global businesses, with Bitcoin, which offers immediate economic empowerment and hope.
This is where it gets really interesting for me, the contrast between traditional economics and engineering. Saylor views 20th century economics as an art that's filled with superstitions, subject to political whims and, religious fervor. Bitcoin, however, is built on engineering discipline. In engineering, like rocket science, failure forces consensus. If you do the math wrong, the rocket burns up. The economic protocol of Bitcoin is built on unyielding mathematics, forcing rational consensus globally.
The profound implication there is that Bitcoin represents, and this is a quote, the ability to tightly bind economic energy to the individual through a mathematical and economic protocol. That is the transformative change in economic history. It gives individual property rights that cannot be confiscated, diluted, or inflated away.
So what does this all mean for you, the learner, as you track this rapidly evolving space? We've seen that 20th century finance universally offered return-free risk, asking you to accept duration and credit risk without any offsetting yield. So what does it mean for society, for conservative capital, and for global finance when a major bank, leveraging this new digital capital stack, can credibly offer hope by paying 8% daily on digital assets? The competition for the world's capital has begun, and the rules of liquidity and yield have been permanently rewritten.